Thank you for joining me today. Before we dive into today's topic, allow me to introduce myself. My name is Raymond Gan, the founder of Investment. Headquartered in Tokyo, our company's mission is to guide businesses through complex regulatory challenges and provide comprehensive financial support, with a focus on international markets such as Japan, Canada, China, and Hong Kong. My linguistic proficiency in multiple languages allows us to navigate diverse business landscapes, offering a unique perspective to today's discussion. Now, let's delve into a financial spectacle that still looms large over modern markets: the Japanese asset price bubble of the late 1980s and early 1990s. In the late 20th century, Japan was more than just an emerging global powerhouse. It was a shining beacon of industrial innovation and technological marvels. Companies like Sony were not just participating in the global electronics market, they were defining it. But the very successes that made Japan a global behemoth also set the stage for its dramatic financial downfall. Two critical factors contributed to the genesis of the asset price bubble: the Plaza Accord and Japan's monetary policy. The Plaza Accord was far more than just an international agreement. It was a seismic shift in currency valuation that had ripple effects across the global economy. Likewise, Japan's monetary policy did not just influence domestic interest rates, it set the stage for a torrent of speculative borrowing that inflated asset prices to unsustainable levels. Describing the late 1980s as an economic party in Japan would be an understatement. It was more akin to a financial carnival, a jubilee of excess that permeated every sector of the Japanese economy. Land values weren't just high, they were astronomical. The stock market didn't just grow, it soared. The numbers were staggering. The Nikkei index reached almost 39,000 points. The value of land in Tokyo reached prices that were not just exorbitant, but stratospheric. Rumor had it that the Imperial Palace in Tokyo was worth more than the entire state of California. But what goes up must come down, and the Japanese economy was no exception. The clock struck midnight and the party was over. The inevitable happened and the bubble burst. The Japanese economy wasn't just cooling down, it was entering an ice age. Skepticism was in the air, and alarm bells were ringing loud and clear. The stock market didn't just decline, it plummeted, evaporating trillions of yen in paper wealth in a blink of an eye. Likewise, the property market didn't just adjust, it crashed. This wasn't just a market correction, it was a financial cataclysm that resulted in a domino effect of bankruptcies and foreclosures. The repercussions were not short-lived. They were persistent and crippling. Banks transformed into zombies, paralyzed by bad debts and unable to perform their basic functions. The term lost decades isn't merely a catchy phrase. It encapsulates years of stagnation, inertia, and economic malaise that plagued Japan well into the 2000s. In the aftermath, Japan underwent a soul-searching exercise that led to significant regulatory reforms. These reforms weren't mere adjustments. They were overhauls that have had a lasting impact on economic thought and policy, not just in Japan, but globally. Stricter lending criteria were introduced, along with increased transparency, heralding a new era of financial governance. But let's not relegate the Japanese asset price bubble to the annals of history. It's a living lesson, as relevant today as it was then, especially in a world characterized by volatile markets, geopolitical tensions, and economic uncertainty. As we navigate the intricacies of the financial landscape, we must never forget the lessons learned from the Japanese asset price bubble. They serve as a potent reminder of the risks that come from speculative excess, poor regulatory oversight, and collective amnesia.